Yeah, very good morning again, Ravin and Samindri. So we'll start until others get in. Right. What we have been doing last week is basically, first of all, Ravin and Samindri, you can see the screen as well, right? While I'm hearing, you can see the content. Okay. Right. So last week, what we did,
Yeah,
we briefly discussed about the syllabus, overview of the syllabus, and then we discussed what are the 4 areas that we need to study. That's introduction, SME banking, microfinancing, and the project financing. Then we again move to discuss about how to write the examination paper, what's like the question breakdown, and what is kind of your expectation in writing, where especially writing answers in point form. And then I expected a kind of some contribution from you while you are you're studying, like what are the areas that you need to do about outside reading, and again bit of studying, self-studying, like past paper sort of thing. So we discussed those things as well. Then we move to the bit of introduction, and there we discuss about why the project financing is important, right? And what's the nature importance of the project financing, cycle of the project, and then we discuss briefly into the different steps of the project financing as well. So we come to a level where we started, learning about basic categories of lending. There were 4: asset, cash, project, and fee-based lending. So we discussed fee-based lending and the asset-based lending last week, and then we are, about to discuss about cash flow-based lending and project-based lending. So, any questions from what we have done last week? Anything to be, further clarified? Roshni, Raveen, Samindri, anything that you need to bit of not clear, or everything is clear, or if there is not, uh, 100% clear, anything to be clarified? Any areas?
no, sir.
Right. So let's move on. Then, if you have to do anything, yes, you can raise your hand. You can text a message or whatever. Right. So basically, I'll just touch what we have done last week also: asset based, cash flow based, project based lending. There are 3 areas that we want to study, and on top of that, there was one thing that is it's a fee based lending. So the fee based lending is basically where bank is offering contingent liability, off balance sheet products to the customers. And then when you're offering the off balance sheet customers, you are not off balance sheet products to the customers. You are not offering anything to the client in terms of cash out, but you offer a kind of undertaking, obligation. In case of a requirements, we will undertake you, like a bank guarantee, like a payment guarantee, like a shipping guarantee. For that, you are getting some income for that offering. So that is basically called the fee-based lending, like letter of credit, bank guarantees, shipping guarantees, so on and so forth. That's it. Then we try to learn something about asset-based lending. Asset-based lending is predominantly we offer product to a customer based on the value of the asset, like pawning, gold loans, cashback loans, cashback ODs, to some extent leasing, right? So basically, there you discuss about the value of the asset. So based on the value, so you provide the customer some kind of a percentage out of it, advance out of it. Say 90% of the fixed deposit could be your cashback OD or cashback loan, or maybe 60 to 70% of your savings account could be a facility that you can offer to a customer. So, like there may be set guidelines in order to further understand, but we predominantly discuss about the value of the asset. When you talk about the value of the asset, this is how basically we are offering, granted based on the value. We are not very much critical or very much worried about the source of repayment, right? Because we depend on the value of the asset. And again, timing of the cash flows, when you are going to repay. So those things are immaterial for us under this type of lending. I am going to say that, this is not the correct or wrong, but there is a type of lending we can understand which is prevailing in the market. Then we have some advantages as well as disadvantages. Advantages like lending appears less risky. Why? Because there is a underlying asset in case of emergency. If you are unable to recover, yes, we talk about the asset underlying that transaction. The loan based on value of the property, easy to determine, right? There may be cash, there may be shares, there may be property, there may be gold, right? So you know the value of the particular property asset, and then easy to determine what is the value, then how much should I accommodate to the customer. And then disadvantage also equally there, like because loan size is based on the borrower's repayment capacity, irrespective whether he can pay 100,000, 200,000, 300,000. We are no worried on that. So instead we say how much you have, so I can give 80%, I can give 90%. Then repayment schedule also not based on the cash flow, irrespective that how much is generating, maybe first year, second year, third year, first month, second month, third month. So we are no more worried about that. So we basically worried about the value, asset value. Sometimes the disadvantage should be value of the property could be go up and down. It could happen, right? So gold, for example, could go and up and could go down. Even a property could go up and go down. So could be a disadvantage in case of the property value is coming down, whereas your asset, whereas your advance value is higher than that. So advantages and disadvantages. So next one is the cash flow based lending. That's we are going to learn as number 2. So here it's a bit of understanding required where now cash flow based lending, there are 2 types. One is you talk about the present cash flow. The other one is talk about future cash flows. So when you say present cash flows, is basically you discuss or you worried about customer generating cash, maybe near future or maybe immediately. So then your loan is decided, loan is set, loan is structured based on that cash flows. And then example, your repayment schedule is based on the borrower's timing of cash flows, right? Then repayment schedule is based on borrower's timing, right? How much you can pay during the first year, first month, first quarter. So then you set your repayment amount in tallying with that. That's the most important thing, cash flow based lending. Collateral is not primary consideration, like asset base. Here, collateral is not the number 1 primary consideration. Micro loan, salary personal loan, business loan. So you very much focus on cash flows. This is the difference between asset versus the cash flow. Again, when you say cash flow, we talk about present cash flows, not the future cash flows. Future cash flows, yes, you have something to talk about, so we'll discuss with it later. Right. Again, advantages and disadvantages also there. So what are the advantages? Default due to fund diversion minimize. What do you mean by that? What do you mean by that? Default due to fund diversion minimize. Any thoughts? By the way, anybody who joined today, who are not with us last week? Anybody who joined today? Ramidu, were you with us last week? Yeah, Chandran, yeah, very good, warm welcome to development financing class. So we have started last week about introduction and the syllabus area, but you can easily go through the content once they publish in the YouTube, IBSL. So if anything, please, let me know that in case if you have any doubts, so we will get cleared then and there. Thanks, Chandran. So hope everything, the others basically we were with us last week. But if you are new to today's class, please let me know, like, if you have any doubts, unclear areas on what we have done last week, or when we are continuing, please let me know so that we can add some value or kind of a clarification in going forward as well. So in cash flow based lending, yes, we have one advantage where we talk about default due to fund diversion minimized. What do you mean by that? Now, if you take asset-based lending, customer coming to you and put a deposit and ask some money. So provide the money back to the customer. Are you asking what is the purpose that you are going to use this? When, what's the like project? How do you are going to use this? We may not asking, right? Because it's not our business. Or maybe customer is not very much willing to disclose those information to you. Like gold, owning. If you want to ask those questions from the customer, probably he might not be in good books with you, because I came to do a bit of pawning with you, but now you're asking so many questions which are irrelevant to my transaction. So why? Because in asset base, we depend on the value of the asset, not the cash flows. But when it comes to the cash flow based lending, it's your primary question. What is the purpose? What's the end use? On what you are going to use this money? Because if you are thinking in that line, means the fund diversion could be minimized. Let's say customer wanted money to invest in working capital. So he's asking money, then you think about, right, stock investment, data financing. So you know exactly where the funds is going to. So that's what they say, default due to fund diversion minimize, because you can't zero that into a level where avoiding or minimizing, or erasing that type of a thing. No, you can't. But there's a chance that the customer could do that. But it could be minimized. So minimize in the sense the money could be used for intended purpose, so that the customer can generate money from that activity, which is good for you and as a customer as well, because then your repayment is coming from that source. That's very important. Part 2, loan size, terms and prepayment based on borrower's cash flow. That's again important. Loan size, terms and repayment based on borrower's cash flow, which is absent in the previous category of lending, where say the customer generating, so for example, you are an employer in an organization. When you go to take a loan from another bank, you say, I want to take a personal loan. This is my salary. How much you can pay? So you say that this is how much I'm going to pay. This is whatever my capacity. And then based on that, they will decide the loan amount that they would give. That is something 10 times of your salary. So basically they have decided your loan based on what you are earning. Similarly with the other loans, because at present how much you are generating. At present, what is your cash flow? Monthly, quarterly, annually, biannually, like that. So based on that, they will set the loan. Third, best suited for short-term working capital. That is again telling, because it's like short-term, current orientist, and you know how much you are going to generate. So based on that, you will provide a particular loan. So it basically have some advantages like minimization of fund diversion. Repayment is based on the borrower's present cash flow, and terms and conditions also being set on that. Third, it's suitable for working capital type of financing because it's current. Because working capital also depend on a very short-term perspective. Those are advantages. Any questions from the audience? Anything you want to get it clear?
Sir, can you explain the advantage? The first one, if you don't mind, please.
Right. So default due to fund diversion minimize. It means now under the cash flow based lending, like a previous asset based lending, here we are worried about the utilization of the cash flow. Right? Let's say you are running a store and you want money to finance your working capital. And then when you go to a bank and you say that I am so and so, I want funds for my working capital. So why don't you give me a credit facility? So probably they will ask question, what is your stock levels? What's the terms of trade? What's your debtor level? What's the check return ratio? Who are the top 10 debtors? Like that. So they do a detailed analysis on your working capital. And then they approve a particular credit facility. Let's say if they are going to finance your debtors, probably they might give like invoice discounting, check discounting, inventory financing, factoring, import financing loan, right? Except import, those three could be debtor financing products. But let's say if you want to stock financing, they might think about short-term revolving loan, pledge loan, import loan, hypothecation loan. So like that, then there's a stock-oriented loan facility. So then once you approve that, then there may be underlying condition for that. Let's say import loan, maybe 3 months at maturity you have to repay. Stock could be mortgage. Stock to be insured. So probably if LC, IFL, LC to be retired through the funds, and then the IFL will be created. I mean, not you are giving away the money without checking what's the end use. So by when you are trying to do that, then we can say we can control the end use. We can request the customer to use the funds for intended purpose. That's what we say fund diversion minimize. But if you take asset-based financing, irrespective of the purpose, you give the money over the counter. You never know the customer is using for the money for personal use, business use, some other. We even can't ascertain because we can't ask the questions also. The customer is not bound to respond you in a cashback facility. He might say, I have money. So why are you asking questions? Because it's loan against my money, my deposits. Roshni, is it clear?
Yes, sir. Okay, thank you.
Anybody has any clarification? Chandran, Navas, Ravidu, anything to clear on advantages?
Clear, sir.
Fine, very good. So then we go to disadvantages also. So disadvantages is there are equal disadvantages in this category 2. That is conservative loan sizes initially could work against low income clients. What do you mean by that? Any thoughts? Conservative loan sizes. And this could have an impact. The low income clients, it could be something microfinancing, or even you at the start of your career, maybe you are earning something reasonable amount, but you have the potential. Say, when you go to a bank and you say, I'm so and so, I want a loan, the bank would say, yes, this is your take home salary, and so you might give 10 times of that. You might say, no, this is not sufficient. You know that I am going to get my next increment by next April or December. I'm going to promote as a branch manager in another 6 months. So then my salary would be like this. Can you consider? So probably they say no. Under this type of lending, we can't think about your futuristic opportunities, your potential. What you are right now earning, what you are right now contributing to your salary will be your decision points. So it's a disadvantage for you. I know I have the capacity, potential, right, in another 6 months, but you can't ask more money based on your future perspective. Similarly, if you are a microfinancing entrepreneur, micro entrepreneur, yes, today you are earning only 250,000 per day. Hence that what the bank could provide is something, this much of money. But you know for sure, if I am getting more, I could have done more. But the bank is not in that position to understand, or not rather understand, to justify that your future potential. Because today, what you are earning is this much. So that works against you. But if you are a low income earner, low income provider, low income generator, so it's a disadvantage. Never mind, we have answer for that in next type of lending. But in case of cash flow, present, current, you don't have an answer for that. So it's a disadvantage for you. Not the best tool for determining loan requirements of project needing capital expenditure or long-term investment. Again, very good point. Say you are working, now you think it is enough to do a job under somebody else, then you want to go and start your business. You have some capital saved from your current job. I get a loan for this project proposal. So probably the bank would see, no, right now we are not generating anything, no cash flows. You have resigned from the job also. So we might not be able to give you money at this point of time. Why? Because there's no cash flow is being generated right now. Then the bank is not in a position to tell you or let you know that bank is approving. Bank is considering a credit under cash flow based lending. Similarly, there is a micro entrepreneur, and he wanted to, enhance the business or go to next level, and it comes to you and ask a credit facility. But as a bank, you are unable to provide that opportunity, that request, to cater that request. Why? Right now, we are not generating adequate cash flow to support that a big opportunity, a higher financing quantum. Because yes, future, yes, you would do, but for the time being, you are not. Hence that I am not in a position to finance your capex requirement, futuristic working capital requirement, enhanced financing requirement. Hope you got that. Any questions from that disadvantages area? Anything? You can ask questions, or you can suggest, you can share your experience. I mean, no harm. That obviously could benefit the rest of the team also. Nothing? Great. So move to the next part. So basically, in again on the cash flow based lending, it gives the idea to us where how much loan a prospective client can afford to pay, how long the term of the loan should be, how frequently. That's the main difference between the asset-based lending versus the cash flow. When you talk about cash flow, you know for exactly sure how much he can pay. Like your personal loan, they upfront, they know how much that they are going to approve and how much you can pay. How long that we will approve based on the current cash flow, current monthly installment, they say 84 months, 60 months. And how frequently, monthly, quarterly, biannually, annually, or if it's a working capital, weekly, every fortnight. You understand? Monthly, quarterly, they know in upfront because they know the current cash flows. the amount, a timing, and everything is clear. So hence that we are going to prove that. So that's a second or rather third, fee-based lending, asset-based lending, cash flow-based lending. Finally, a project-based lending. Again, if you remember, we discussed last time about project financing. It's nothing. A project-based lending is similar as project financing, infrastructure financing, capex financing, almost the same idea with a bit of changes, but in general, at large, it's common word, common financing. But main difference between cash flow based lending and the project based lending is a timing, or rather happening of the cash flows. In cash flow based lending, we talk about current or near future cash flows. But in a project, it's futuristic cash flows, expected cash flows, a projected cash flows. You see the difference? Now, same, you go to a bank and asking a personal loan, a bank would approve a personal loan based on your current remuneration. Similarly, you go to a bank and say, though I am so and so, we are going to have a business, maybe a restaurant, maybe a cafe, small IT shop. That this is my project plan. This is how I generate my income. First year, second year, third year. So this is my capex financing requirement. This is my working capital financing requirement. So then the bank would evaluate that futuristic potential of the project, then approve a loan. So two scenarios. One is based on current, near future, today's cash flow. The rest, expected, projected, futuristic, potential cash flows. Hope you are getting the difference between the project financing or project-based cash flows and current, near future cash flows. Okay. Method of cash flow lending, which based on the future expected of the project or activity to be financed. Collateral is a secondary, very important, like cash flow based lending. The project based lending also, collateral is a secondary. It's not a thing that you are worried. It's good to have, but it's not the primary consideration. Primary consideration is a viability, feasibility. Remember in day one, we learn about project formulation. There you talk about feasibility and feasibility. We discuss about the viability. We discuss a bit late, some more in this word, some under this concept. This is about viability. Means whether it is a potential, whether they can generate cash as expected, whether it's viable in terms of financial perspective, economic perspective, technical perspective. There are so many areas that you need to worry about. So everything will be tested there. Again, now a difference between the cash flow versus the project base is basically, even you are taking a risk, it's about future. If the things are not happening in the future, it could be a issue for you. Why? Your decision is based on future. Right, we'll go further. What are the advantages, disadvantages on this as well? Now, advantages and disadvantages is like, now repayment is based on future cash flows of the project. That's very good thing. Why? Because whether your repayment is based on today and the future will let you know how much you can obtain. Now, early example, you are a micro entrepreneur, but as of today, you are earning 50,000 per day. So then the bank would think about your capacity for a daily is 50, then my loan amount would be equivalent that you can pay a daily installment of 50,000. But similarly, the particular entrepreneur now have a plan based on the future potential, a daily income generation expected is 250. Now the loan amount is not, say, 500,000. It could be 2 million or so. Why? Your potential earning is 250 per day. You see the difference between cash flow versus the project. So repayment is based on the futuristic. So if you are putting up a hotel, if you are putting up another factory, so all are futuristic, based on future. So no more issues with current restrictions. Then number 2, startup projects may qualify. What is that? Like you resigning from the job and starting a new project, new business is qualified under this. Or maybe a micro entrepreneur. They right now they are doing at very low scale, but they have a potential to go to the next level. Then they are benefited. Best suited for development project or programs. Earlier we were talking about working capital financing is bitterly financed through cash flow based lending. But here we talk about the development financing project, infrastructure projects are being properly financed through this project based lending because it's easy to evaluate the future cash flows. That's a advantages, right? Then disadvantages also there. What are the disadvantages? Highly prone to diversion of loan proceeds by the borrower. What do you mean by that? Any idea? Why the fund diversion? In working capital or in cash flow based lending, we say fund diversion is minimized. But here we say there's a highly likelihood in fund diversion. Any thoughts? Why? Anybody can tell anything. Why is it so? Roshni? Raveen? Any thoughts? Why do you think that fund diversion can happen here in public lending? Anything that come to your mind, you can mention so that we can discuss further. Any thoughts? Why? Tanya? Nawaz? Why do you think in project financing, why this is possible? No idea. It's like this. Now, cash flow based lending, you know exactly where you intended to finance. There's stock, debtors, and if debtors, that what type of debtors, how we are going to finance, so everything is clear. But here, it's all about future. Maybe today you don't have anything to physically identify. It's just a project paper, project report, kind of a discussion between the borrower and you. So we think about building, we think about machinery, we think about vehicle, contingency, working, all are projected. Right? Then they say building, square feet, this is the cost, and there may be cost overrun. So you provide this, so sometimes the customer could do that too. We can partly undertake that. So means you have to risk. You getting my point? So futuristic, even right now, nothing physically existent. Then there is a risk of fund diversion. You give the money to put up a building, so he can do perfectly complete building, or he can take some money out of that and do the construction. There's a chance, but you have almost every control to prevent that, but there is a likelihood. Because again, futuristic, not easy to control. It's spread over period of time. Number 2, require extensive analysis on the feasibility, viability. If you remember correct, last week we discussed about the feasibility. When you talk about financial feasibility, I mean, very difficult to judge it. Where financial, it should be about P&L, balance sheet, cash flow, ratio analysis, and everything about future. Some set of assumptions, based on that you say this is the turnover figure, this is the cash flows. So based on that you are going to pay my debt. If something is going to happen, then they can't repay. Oh, marketing feasibility. It's all about so many factors. Competition to market outlook to customer taste differences, changes in the market, regulations. I mean, a lot of things could impact your market. So see what's happening today. So if we have finance entrepreneur, assuming everything is like BAU, business as usual, now you see the difference, right? The COVID impact totally, upside the market. Now, maybe you and the customer initially assume the turnover of 100 million in normal course of business, but now even you think about the 15 million probably because the lockdown and all that. So what would now do? He can't generate adequate funds, cash flows. Repayments are not sure. Hence that you need to offer even the moratorium for a new project loans also. So viability, feasibility could be checked at a higher cost, because now you need to decide on how viable, feasible those are. Based on that, you undertake financing. Anything, anytime can go wrong. Will have impact to your cash flows. That's a tricky riskiness of this project financing. You need a bit of advanced knowledge, expert knowledge onto this. Last one, highly vulnerable to various project risk. It's good that you talk about positives like the feasibility, viability. But the flip side of that is a project risk, right? When you say technical feasibility, if everything is pluses, it's positive, right? What would happen as something going against that? It's a technical risk. Say, example, you bring down the machine, you expect to perform at this level. Now you see that capacity utilization is not forthcoming, or there may be some further modification to be done in terms of process to get that output. There's a mismatch in input and output, some efficiency issues, productivity issues. Hence, technical risk could lead to marketing, could lead to financial risk now. Those things are futuristic. Today you can't say, even a market. Right now you don't have a competition, but in another 2 years' time, there would be a huge competition. That will have an impact on your income generation capacity. It's a disadvantage. It's a marketing risk, market risk. Similarly, structural risk, operational risk. So many things could happen. You getting my point? right? So advantages, disadvantages, project financing. So now basically what we have done so far is introduction to the project financing, and we learned several areas today that we just completed about asset base, cash flow base, fee base, and the project base, like 4 areas of categories of lending. So any questions from you, even what we have done today or even the last week? It's up to you now. Question me or question all of us. Chandran, though you are a newcomer, you can ask a question. Gihani, probably I think you also new face to us. Ravindu, Roshni, you were with me last week. Any question? Any gray area? Anything to, sorry, Ravin and Roshni were with us last week. Ravindu also, I think today, you joined today, if I remember correct. If not, sorry about that. Any questions? Any questions? Yes, Thiru, Shashika? All clear? Nothing to worry. As I was telling, though this is basic, there may be questions being set on these areas also. So that's why I wanted to know, I took some extra time and to explain this is like very basic, but yes, you need to understand those things very well, because your future questions will be based on these basics or fundamentals. Okay, all good. So assume the silence means that you are happy with what we have been doing. So please let me know if anything is not clear, right? So that you can continue, revisiting and discussing again. So finally, this is basically what we have done. So you better understand whatever the content in question form. Yeah, nature, importance of the project, why project financing important in developing economy or country like Sri Lanka, brief description of stages of project cycle, basic categories of lending, compare and contrast each categories of lending. So these are the 5 areas that we need to be thorough with once we complete the first session, first lesson, I must say. So these are the probable questions that we can expect from the examiner in case if it is going to give some questions. Hope that you have answers for all, not stopping at this point. Yeah, you can go to a next level where you can refer papers and articles which are happening in today's perspective and get some insight from that also. What are the major projects, how the government is going to arrange those things, right? So what basically the type of those projects, like private government partners, right? So operating various capacity like build, operate and transfer, build, operate, own, BOO, BOT. So like that, there may be so many things that you can learn when you refer the current things in the economic and the country perspective. So try to get those things as I always encourage you to make a separate file, keep documents. I think I have shared several articles in our groups also, right? So that you can refer that as well. There are several student groups we have created. So there again, whenever I see a kind of good article, I will share it. It could be relevant to monetary, it could be relevant to fiscal policy, country's development, SME, right? If you also come across those things, please share among those groups so that it will anyway benefit not only development and credit financing students, credit management students. There are other students also obviously would be benefited on that, current context, current trends, right, which are relevant to banking and economic front of Sri Lanka. So having said that, so we are almost concluded the lesson 1. If you don't have any questions, we can move to the session, the lesson 2. So any questions again the last time? All clear? Right. Can you see the screen, module 2, SME banking? Rabin?
Yes, sir.
Okay, good. Let's move to that. Basically, under this, we are trying to discuss these areas: SME banking, definition and importance, understanding what is SME lending and SME banking, rationale in developing financial products for SMEs, current market trends in financing SMEs, so different financial products for SME. So that's what basically we are trying to understand during this session. And at halfway through that, I have given you some reading materials, which we are not going to discuss in the class, depending on the given the time restrictions, but you are welcome to read through those things and get familiarized, because those things are coming for exams about the product descriptions. But to support that, so we will discuss past paper questions where you have product description and all that, because if we are going to do the same thing class and the past paper question, so that's a kind of repetition. So hence that what we are trying to do is like I have given it as a additional reading for you, but though it's additional reading, it's additional to the a lecture, and you are supposed to go through and get memorized at least 10 to 12 products, because it's very important for it as a customer offering, right? So before starting this, it's SME banking. What are your thoughts in general? What is SME banking? What do you understand in practical? So let's have some kind of brainstorming session, and then we will move to that. Later we can think about those importance and everything. What do you understand by SME banking? Why it is important? Are many banks in Sri Lanka engaged in SME banking? Or if it is so, why? Yeah, just your thoughts. It's not me right or wrong, but your opinion. You need to speak up, guys, because otherwise it's a one-way communication. It always be obviously benefited. Roshni, anything? As you understand, what is SME banking? Generally, it's not a regular definitions that I am asking. What is all about? Nawaz? Raveen, anything that adhere? Whatever come to your mind, just speak up. So we'll fine tune our discussion based on that. Why the government is so keen on SME banking, SME financing? Why other countries like Thailand, Vietnam, Bangladesh, right? Even the German, like developed countries, why they are interested in SME, small medium enterprises, small medium industries. So we can name it in different way. Why? How do you understand? What is their role? Tanya, anything to add here? මොන හරි කියන්න. මොකද සද්ද නැතුව ඉන්න එකේදී වෙන්නේ අපිට අර ඩිස්කෂන් එක අපි හැම වෙලේම ලෙක්චර් එකට සීමා වෙන්න පටන් ගන්නවා. They're not going beyond that, because that anyway it's available now. Lecture notes are available. But we need to add something. So we need to brainstorm. Anything? Ravindu? Roshni? Samindri? Anything to add? Chandra? Why you are silent? What do you understand? Why it is there? So have you come across your bank financing SMEs in your markets? If so, what are the areas? Roshni HNB, let me know. Have you started recovering money from SMEs, SME customers? What is your experience? Tanya, I think you are from also HNB, right? Ravin, any thoughts? Are you experienced? Have you any experience in financing SME, whether your bank or your branch? Do you have SME customers in your branch? Nobody's answering. Why is that? Am I hearing to you? Can you all hear me? Some issue, because it's like not a difficult question I'm asking. Chandan, which bank you are working? Which bank you are working?
Sir, another question because I lost electricity for a while.
Right. Ravin, that I am asking is basically, now, have you come across any SME customers in your branch?
Actually, so SMEs and basically they are not public limited companies.
Right.
And the SME is defined as the below profit below 750 million according to
Okay.
the
Right.
And because they are not liable, because they are not liable to public,
Right.
we have to be vigilant to lend them, because
Yes.
they can run with the cash that we
Right.
are lending.
Right. Good points. Anything to add, like Roshni? Chandran, anything to add on SME clients, SME business? How do you see the SME business? Is a risky business compared to corporate type of business, or it's a less risky? Yes, very good point. Most of the businesses in our country falls, like more than 50-60% are in SME. That's another important point, Namas, you are telling, because you can't survive without financing to the SME, right? So basically, if you are a bank, and then if you want to be in the mainstream banking, yes, you need to undertake SME financing. That's what the Namas point stresses us. Yasiru, Tanya, anything to add? Ravindu, what do you think about SME customers in your bank, in your branch? How do they behave? Can you easily judge their behavior, repayment capacity? The corporate section also depends on SME. Yes, very good point. Why Ravindu is telling like that? Because let's say in a country like this, there are corporate clients. They need some inputs. They need some services as their inputs, where they can get it from SME customers, right? So another, I have seen that SMEs are backbone of an economy. You had something about what Nawaz is telling, because they are the input to the big corporates, right? So otherwise big corporates cannot survive, because they can't do everything from A to Z, right? So they are input based on SMEs. Some of the outputs from SME is the input to the cooperate. Very good thoughts. Anything to add? Ravindu, thank you. Nawaz and Samin, Ravi, you have given some valuable thoughts. Because others also can speak up. Because don't stay silent. Then I understand. So you know everything. I just also going through this. But at the end of the day, when the the questions comes, so we are in two different mindsets. Because I presume everything is imparted, but you have not. Because when you speak up only, we understand the level that we need to go. Because every time we can't go to the trash and start that, because very short period, so we need to see exactly what is our level, and then we can move from that onwards, and then we can pick so many additional points also, because that is what the examination requirement also. I think last week I expected and I explained you what exactly the examiner's requirement is, impression, right? So then you need to work on that to get a good rating, good grade. Because otherwise you might come and say that I have done everything very well, but when results comes, you have not achieved whatever you expected. That is because mainly you are having a gap between examiner's expectations versus our expectations. So you need to minimize that gap. So in order to do that, so you need to understand what we are discussing at the class. Probably there may be so many things in the content, the presentation, that easily I can deliver within 30-40 minutes, but that doesn't serve the purpose. So you need to speak up. So come up with whether you know this, you understand what you do, have anything to add more, and you know better than what we are mentioning here. And because those are important for us to do these sessions, right? So please have your views, because even you can put a message, you can speak up, right? So make this as a platform where more constructive, right? Not a one-way traffic, like I just telling this and you listening that. So no point you are joining here, because everything we are uploading in the Google Classroom, so you can have it, and even you can listen to my videos also. That doesn't serve the purpose. So please understand that. So try to make more interactive sessions, so that would be very easy for both of us to make a value out of this. So these are the things that we are going to plan today, right? Right. So here we talk about a definition, right? In the definition, yes, there may be so many things that we can understand, where in general we don't have a particular universal definition for SMEs, right? So generally we don't have a unique definition for SMEs. Hence that the country to country, we are using different definitions. That's one that you need to think about, because sometimes they might ask a question, what is the SME definition? So probably you might have to put a current definition, and then you need to write these points as well, because then only you can get that particular marks. Or they might ask a question like, what is the criteria of defining SMEs? That's another question that they have asked in several times. So you need to know what are the criteria, different set of criteria in defining SMEs. That's also you need to know. Again, that you need to understand why this definition is needed. So before we move to the slide content, why do you think we need to define SMEs? Why we need to define SMEs? Any thoughts? Yasiru, Roshni, Tanya, any thoughts? Why we need to define? Can't we do the banking business without defining these customer segments? Any quick answer? Why we need to define? Somebody could say it's a regulatory requirement. Yes, because as per the central bank, yes, we need to understand what are the SME segments, because it could be a requirement in terms of capital provisioning, capital adequacy calculation. More technically, we need to understand who your SMEs and who your corporates, mid corporates like that. That's one. Number two could be administrative purposes. You have department called corporate, you have department called SME, you have department called retail. It's good that you define and cluster them accordingly. Then you have a more focus and value added service to these customers. Because otherwise, so if you are very good at corporate lending, then you put into SME type of customers, that doesn't serve the purpose. To get an exact idea on their, that is, yes, a very good point. You have add some more value to that. Exact idea on their behavior, performance, and to focus more. Exactly spot on, Nawaz. Very good point. Because now when you say retail customers or consumer lending, it's a different approach. SME segments, different approach. Microfinancing, different approach. And corporate, further different. So when you defining, when you understand these are my SME segment, then we know what is their behavior, how the repayment pattern, what are their normal financing requirement, what are the the pluses minus they do have, right? So then you have a very focused approach to get maximum out of that. That is another kind of a requirement of defining these SMEs. Maybe regulatory, maybe as Nama was mentioning, that's more focused approach to get an idea about their behavior and their pattern. Administrative purposes, or rather maybe what do you call statutory requirements also, like 10% is on agri, this much of for the export, this much for SMEs, because there are time to time there may be some requirements from the government regulated in terms of lending. To understand that also you need to define and to understand where you are going. In terms of performance, as Nawaz mentioned, very important, whether liquidity level, NPL level, impairment level, important, right? SME clients in paddy sector, SME clients in construction sector, their behavior, their performance is different to the similar segments in corporate. If you put everything and then say it's a branch banking, it's a bank business, you might not be able to segregate and get an idea about what is the exact output, trends. So keep those things also in mind. Sometimes, in exams, they might ask very general question. Why do you think that, SME clients could be predefined? Write a short answer. So 1, 2, 3, 4. I mean, you are learning, but you have not thought about the kind of a question from the examiner. So you need to put the answer for that also to get these 5 marks. So thinking that way also. Very fundamental question. We talk about definition. Good to have definition. And we also mentioning there's no universal definition to define SMEs. It's still a problem we are having it. But then why we need a definition? Because we need a definition for this type of requirements. That's what the examiner would ask us. Then very important examination perspective again. What are the criteria? It's a top left-hand corner. It's a number of people, amount of capital, amount of turnover. There are 3 main criteria being used by different countries or different organizations, institutions to define SMEs. Somebody would use all 3. Somebody would use at least 2. Somebody would use maybe 1 criteria. Right. So when you say criterions, you need to write these 3: number of people, amount of capital, and amount of turnover. Okay, that's a criteria. Then come to the right side. There are several definitions we could find in defining SMEs. Enterprise with fewer than 50 people and capital investment less than 5 million. sometime back, Department of Small Industries, that they have defined less than 50 and capital investment is less than 5 million. Because sometime back, SME had been defined in that way. Or as per the EDB, they have defined enterprise with less than 8, investment less than 50. It has been changed over time. Recent past, we have seen turnover below 600 million or in terms of businesses. Now, what's the current definition? As Ravin mentioned, it is 750 million or below. Annual business turnover should be less than 750 million or below is categorized as SME, which has been vetted by the Center CBSL and it has been put forward by Industries and Commerce Ministry. So the current Sri Lankan definition is annual turnover 750 million or below. So there may be enough questions to that extent, and they have asked. So if you are coming from 2014 to right now, there may be several definitions, but the current definition is 750 million or below. Right? That's why I have given several definitions which are outdated now, but they were being used time to time. So the first one is what are the criteria? There are 3 criterions, and there are several definitions, and the current definition is 750 million or below. And again, as I was telling, there may be no hard and fast universal definition across the world to define SMEs. So that's why we also have different definitions time to time. So in addition to this general definition, sometimes depending on the credit line, maybe Saubhagya, maybe Susahana, or maybe another credit line would again come and define SMEs because for that financing requirement. They might say below 200 million, below 500 million. Recent past, even the moratorium facilities, they also have defined SMEs. How they have defined? They have defined SMEs based on turnover, and 1 billion and below turnovers have been identified as SMEs to qualify the moratorium. Okay, so that means depending on maybe the credit line, maybe institution requirement, maybe financing requirement, understanding requirements, so we can define the SMEs. But for overall, a generic definition is 750 million or below, which has been again vetted by the Center CBSL as well, right? So hope you see the current definition, though there are several definitions available. That is the most commonly used definition. But remember, depending on the credit line, depending on the requirements, SME could be defined differently. Again, 3 criterions, that is number of people, amount of capital, amount of turnover of the business are the criterions to be used, could be used to define SMEs. Hope it's understood. Any questions? Any questions?
No, sir.
Great. Then we also see how the World Bank has defined them. World Bank, sometime back, they have defined SMEs as if any enterprise has less than 99 people, it can be defined as SME. Okay. Then why we need to have a definition? As a couple of you also gave very good suggestion, but I have also given some more points because the examiner could ask that question very easily. provide concession financial facilities, financial opportunities on target basis. Yeah, if we can understand these are SMEs, so it's easy you to focus and do the financing, because we need to provide them financing at low cost concession rate, because they are anyway the backbone of the economy, the supporting chain to the big corporates there, and they contribute the GDP in massive way. So you need to support them at a acceptable or reasonable cost. Specific business development service, right? The number 2 is like, rather than giving generic product, generic service, so this provide specific business development, service, that also could be given under this. So some time back, actually, Department of Census and Statistics, they started exercise also defining micro, small and medium enterprises, but time to time again they have also come up with some definitions. But as per right now, it says 750 is for SME. Any idea about microfinancing? Any thoughts? කාටට කියන්න පුළුවන්ද microfinancing වලට definition එකක් තියෙනවද ලංකාවේ? What is like turnover levels? Because it was a question for last session. He has asked not only the SME definition, he has asked about the definition for microfinancing also. Any question? Any thoughts? Startups as micro, yeah, Navas, that's true. But do we have an idea about what is the cutoff? Where below this is micro, above this is SME. It's good to have that definition also, because microfinancing is a different proposition. So you learn it on the section 4, module 4. It's right now is 16 million. So keep that in record, right? So below annual turnover 16 million is defined a client who are falling under the microfinancing segment. 16 million to 715 million is defined as the SME segment. Above 750, it could be mid-market or the corporate. So mid-market and corporate, internally we have defined something about up to 2.5 billion is a mid-market and beyond that corporate, but it is not regulatory defined. But SMEs and microfinancing is regulatory defined. So below 750, up to 16 million is SME, below 16 million is micro. So since that it has come to discussion, I have mentioned for that you can keep that as a record, because there are chances that these small things put into the question paper. Right? Any questions? Right. So this is again very important slide, because we see so many questions in the importance of SMEs in the economy. Like, when it comes to the microfinancing, the examiner could ask about why the microfinancing or microfinancing segment, microfinancing clients are important to economy like Sri Lanka. When it comes to the SMEs also, they might, ask why SMEs are important to economy, right? Why SMEs are important. So let's have an idea about some background to the SMEs, right? Generally, right, a country has SME economy where 70% of plantation, 85% of rubber, 100% of paddy, 90% of coconut are smallholders. Like generally, if you say in general, right? So this is a bit of numbers. So maybe 25% of the total population, 70% of the within the SME sector, as Nawaz also mentioned. So 52% 2011, 40% in 2010. Right now it has increased to 60% as of recent past. So these are some outdated numbers, but if you recently see, if you visit the stat department website or central bank highlighted data, so we can say the 60% or more contribution from the SMEs coming from Sri Lankan economy, and then 70% are within the SME sector. 25 to 30% is the kind of population. So many of the sectors players are SMEs, right? So that's about the stats. Stats are not so great because it's keep on changing, but the right side is very important. These are the things that the examiner would anytime ask us. Why SME is important? What's the role played by the SMEs? Right? What do you understand by the SME contribution towards an economy? Those are the kind of questions that they can ask. He can ask. So first one is creating employment opportunities. Creating employment opportunities. Very good. Why? Because in any country, because SMEs are very much in large numbers, so even they create 1 or 2 job opportunities, when come as a together, they support creating so many employment opportunities. That's one. And then mobilizing domestic savings. How they do? Because now if you say corporate clients, they have very limited, right? They have very limited suppliers and buyers also. But when you take SMEs, very large in numbers. So they cater different clientele. I mean, so many methods, so many areas. Means they can mobilize the savings. So they can bring a small savings from different communities, segments, and at the end, so you have a bigger savings pool in a country. If you take Bank of Ceylon, People's Bank, I mean, there's so many SME customers across Sri Lanka. So they are the ones who start making deposits, right? Not all the corporate clients. Even they deposit and they take back the following day. But SME is not like that. So they can make deposits with the banks. Poverty alleviation, that's another support they can do. Because since that, they are spread across the country, they do so many services, they do offer so many products, and then there may be a value addition to the economy, right? Value adding activities. And so many people can engage in these SME businesses, earning some money. So ultimately they can get some jobs, which in turn help to increase the standard of living, reduce the poverty. Very good point. Income distribution. That's another very important point. If you take a few players in the country, yes, they generate money, they save money, invest money, they have money. But it has not been distributed among the rest of the community. But when SMEs are doing job, they are like 80% in numbers. So then the money flows from one to another because they are in so many business activities. So the income being distributed among everybody. So that's again a support incentive or other kind of activity undertaken by the SMEs. Regional development, because there may be rural development, regional development, and they may district level. So since they are there, so their activities will add value to the particular region, particular economy, particular rural economy, local economy. So then development could come. Let's say take paddy, sugar farming, tea sector. So there are so many players. Not the corporate we are talking about, but small tea holders, tea small holders, farmers, agricultural growers. So they add value. Then they are, make some development within the area. Training of workers and entrepreneurs. Training of workers and entrepreneurs. That is again very important. Training of workers and entrepreneurs. They also do a lot of activities. because skilled workers, we expect more and more skilled workers than raw workers. We will have skilled workers, even you can send them to different countries, get more money. So creating an environment which large firms flourish. As I think Ravindu suggested, because the large corporates is benefited from these SMEs because they can survive, they can flourish based on SME performance. Otherwise, they also can't survive, right? Because in order to them to do their business, they want supplies, they want inputs from SMEs. Export earnings contribution, very good point. So everybody talking about dollar and issues and all that, but this is export earnings being it's a contribution. It's a huge contribution because many are numbers, not only one or two, right? If you take coir industry, there are so many players, so they can contribute in different way at different value addition level. So finally, it would bring dollars, euros, sterling pounds. So it supports the export earning. So there are a couple of important points I have given, but very important. So you need to keep these things in mind because this could be tested anytime. So we have seen a couple of previous questions. Actually, we can discuss when it comes to the past paper question level, but I want to highlight because these are very, common questions that the examiner could ask us. This is again not a difficult area, but good to keep this in mind because sometimes very broad questions. He might ask about, SMEs importance in the economy. Why SMEs are important? What is their contribution? Right. So then it's good that if you know some of SMEs in the service sector, some of SME business in the plantation agri sector, some of SMEs in manufacturing sector. So you can give some examples as a 1 point. Because otherwise he might not ask about, what are the sectors SMEs are, play their, operate their businesses. That sort of question may not be there. But when he asks a general question about, SME role in development economy, why SMEs are important, how to understand SMEs contribution in a national economy. If that's the type of question, so you can take some of the inputs from this slide and write a one sentence in terms of SME sectorial performance. Which sectors SMEs are there? Give some examples. So these days you can see, so many happenings in these segments, right? So you need to know what are those, and you accordingly you need to answer. Right. We will talk about some thing more on this. SME lending versus SME banking. Anybody can have some thoughts on this? Any thoughts? What do you understand by the SME lending, first place? Anything you can suggest. It may not have the very correct answer, but you can have some answers. මොකද SME lending කියලා ඔයගොල්ලෝ හිතන්නේ? Generally, when you say lending, it's like a one product orientation. Let's say you are a SME customer, you go to a bank, and then you ask about a credit facility. The bank also would approve a credit facility to you. And then it basically talks about, working capital, business expansion. Yeah, Samidhi, to some extent correct, but rather than that, it's like a one-to-one. Let's say if the customer want working capital facility, yeah, I provide working capital. That's it. I'm now more interested about their personal financing, other business financing, leasing, hire purchase, insurance, or maybe capex financing. So I may not be very interested. Or the other side is something that if you go to a development bank and then they provide you financing requirements mainly into, we say, capex. That's it. They are not very much worried about the rest of the areas, about working capital or balance sheet financing. So may not be, but that's not the right method. As bankers, now we need to be more universal banking, or maybe rather than lending, we should be into the banking. I mean, many banks now are into that. I just want to highlight this as a concept. So lending is typically you looked at one time, one requirement, you cater that, and you are happy with that. But in the other form of banking, other form of model is you talk about banking versus the lending. Here you see the difference. Here you see not only the working capital, not only the capital financing. So you understand, you provide fee-based activities. You provide cash management like CASA, current account, savings account, salary, internet banking. So you think about retail products, personal, pawning, credit card, housing, so many things. Insurance, hire purchase, leasing, financial services, advisory services, liability products. So combination of the products to a one entity, one customer. It's depending on his requirements. Could be he might be an individual, or we can categorize maybe at the inner circle to private bank into so many these things. But even that, he has different product requirement, a service requirement. You try to cater everything. So if I want to take my personal loan from bank A, so they would look into about my credit card requirement, housing loan requirement, my personal financing, internet banking. Even if I want to move to a business, that also we looked into that. If I'm going to take a lease for personal use, that might be also looked into that. So that's like the combination of requirement will be looked by a one particular bank. There are so many advantages of that model as well. Any thoughts from you? What could be the advantages being a sole banker for your all financing requirements? What could be the advantage for the particular bank would have it? Samindri, Roshni, Chandran, control the whole exposure. Very good point, Nawaz. If you say the exposure, one thing, and then if you see the other side is, you can get more income, right? Not only interest income, a fee income also. Customer will not move to another bank. Yes, loyalty, Shashika, very good point. You can retain the customer with your service because the customer may not be moving away. And you can grow with the customer also. So maybe, as Nawaz mentioned, maybe today's exposure is 5 million. So if you keep on supporting, servicing the client, another 5 years time, that could lead to 100 million. That's possible, right? Because you are not let the customer to move out. And you get so many income. What about the risk? Can gain more profits by cross-selling. Very good point, Ramindu. Cross-selling that you can make wonders. Because sometimes the customer is willing to pay more. Because now, you are with him. About cash management to liquid liability management to credit card to debit card to personal financing to their there what do you call minor savings products. I mean, so many things that you can offer. This is like, the very good advantage. Yeah, everything is the positives, could be negatives also. What are those? There may be risk, right? Because one customer, everything with you, right? And in case of something happened to that particular customer, so you might be receiving it, but still you have some controls. Your product portfolio could be long to medium to short, adequate collateral, cash flows intact, insurance in place. You getting my point? And different sectors. So many things you can do to manage your risk. Now it is easy also because you know all ins and out from that customer. But in earlier case, term loan is bank A, working capital is with you, import-export financing with bank C, personal financing with something else, leasing with another leasing company, insurance in another company. Their personal or the kith and kin, and their their what you call about minor savings with another bank. I mean, 5-6 banks. Difficult for you to also maintain, difficult to customer also to deal with. But if you give a better treatment, proper treatment, the customer will be with you. Hope you understand. So we try to go for that banking instead of lending. Universal concept. Make maximum of the particular customer while minimizing your risk, maximizing the profitability. That's your target is with the enhanced, proper, acceptable service. Okay. Any questions? This is again, actually, we have discussed earlier also. If you remember correct, that's what the type of lending categories we discussed. Rationale in deciding financial products. It could be asset-based or security-based. It could be cash flow-based. It could be, again, asset-based and more security-based, more or less same, fee-based and project-based also. Here that they wanted to make two separate things, like security is something about you are doing something about security. But asset is, again, part of the security, but it's something about cashback loans, leasing. So predominantly asset and the quantum of financing. Cash flow is like channel financing is basically a working capital type of financing where cash flow based lending. Fee base is maximize the fee income like insurance, LCs, bank guarantees like that. Here again, you can include the project financing also. That's a future cash flow, projected cash flow. But asset based and security based, you can treat it as a combined, not as a separate, because you can't, figure it out differently. What's like asset, what's the security base. But remember, in practice, you are not doing this always. Why? So depending on the circumstances, you might have a combination of these type of categories of lending. Yeah, asset and cash flow can be combined. Why? You structure the loan based on the cash flows. However, you get a security. Okay. You maybe offer both the asset and the fee-based lending to one single customer. It's a combination. But what I wanted to mention here is, just wanted to tell you, there are several methods, categories, types. That's for learning purposes, understanding purposes. But when you come to the practicality, you may make a kind of a proper decision at the particular time, which again minimize your risk. If the customer is willing to give a property, why should you are not getting that? Though it's a cash flow based lending, it's just good. We all depend on the cash flows, but we try to secure a position through a collateral. That's another important point. Okay, fine. Any questions up to now? Any questions before moving to this? Any questions? Yes, Ramindu has mentioned that. Anything to add here? I know these are not very difficult or different areas, but just to understand. But when you are understanding, again, think very broadly, because examiner put very simple questions because sometimes we are unable to answer. Why? Because we are not very much comfortable of the concepts. So hence that you need to understand more and more on the concepts, basics, then apply it practically. As I told you last week, you can go to a bank branch and see what's happening in terms of what we learn, in terms of how they arrange project financing, how they evaluate SME customers, what they offer, are they into that universal banking instead of the general lending. Then if you think it in that way, you can also give some suggestions like what Ravidu mentioned. Why not you do cross-sell? Why not you ask those questions that he is coming to asking working capital loan? Why are not asking about his personal financing, insurance, leasing? What about their kids' educational plans? So when you're asking, so the client may be interested. So he might think, yeah, this bank is now not only, looking after my business. Now they are, thinking about myself also. So that loyalty could become increased. So like that, you can give some advice to your colleagues in the office. You getting my point? That is the, the applicability. Application. I always, tell my student, application is the key. Otherwise, even whatever you do in your life, application is the key. When you are apply only, you see what's the benefits, what is the cost, pluses, minus, positives, negatives. In Lord Buddha also we have been told no, dukkha satuta, right? So why? Because everything is dependent on what you are going to do, how you face a situation. You learn, you keep it with you, you write exam, you pass the exam, but you are not applying. What's the point? Others is not going to learn. I mean, don't do that. Just speak up. Encourage the others to think in the way that you are thinking. Maybe you are working in a branch, but think in big picture. What's happening in the country's political perspective, economic perspective, financial perspective, global perspective. Just think in that. So these days we talk about issues in sourcing dollars. So maybe, so it's not my problem, right? Because I am in counters. I am in private banking. I am in SME financing. I am in microfinance. No, it's not my business. No, it is not. It is your business. Why? It's a business. It's an issue of the bank, issue of the economy, issues of your big customers. Then what's the point if you supporting SME if they can't sell it to the top corporate, if they can't export? Just to get an idea, what's happening, what's the solution? Why the recently oil prices has gone up? Is it only political reason? No, because dollar is going up. You have to pay more on imports. You don't have enough dollars coming through tourism or other sources. Reserves also coming down. You have to pay a lot of a higher debt component. Getting my point? Just think about. Just read articles. Not everything come to day one. But when you are into that, you learn. Then when you are talking in that language, so you have get a recognition in your branch, in your office. Even now, manager might consult. So you told me something about sector. What do you think about this? What are the sectors that you think about reviving? post-pandemic. Because you just about SME, some sectors, you speak up with some customers, now you get some feedback from them. Then you add on that as a part of your group exercise. Then there is a value for you. Then people talk to you. She told me on what basis, how do you say this? What could be this impact? So then you try to interconnect those some of the happenings. That is the learning. I mean, try to do it from day one. I know it's very difficult. So you have so many works in your office, but still try to do it. Then, you will be at very high level very soon. Because people recognize you, people value your thoughts, people respect you. You also have been encouraged them, motivated to do value addition. Yeah, still you're a teller, still you're operations manager. But you talk about so many things in terms of credit. You understand? So any questions what we have done so far? Give me a minute. Any thoughts? Ushni, Raveen, Navas, Tanya, Ravindu, thank you so much for your contribution so far. I think we can be very interactive bunch of people in next coming weeks. I like that. So it's good that, we get benefited. Very good, Navas. So we'll move to the slide where our current trends, very important. Because as a bank, as a manager, as a decision maker in the bank, we need to see these things, which is in the market. Many banks are right now also doing more concentration on cash flow based lending. Why? Because now you can do capex financing. That's true, but collaterals are limited. Securities are limited. Not all customers can provide collateral. So you need to have more innovative products. Should not based on the collateral. Then you have to capture cash flows, attack cash flows, get a hold of the cash flows, which in turn give you income. Not only interest income, maybe fee income also. Because when you are into that mode. So some banks even offer cash collections. Go to customer doorstep and collect the cash and put into your new bank. That's a very, very service you do with the fee. Why? Control, capture cash flows, more working capital financing, channel financing, distributor financing, supply, you name it, so many things. So you need to focus on that, mainly due to this importance of cash flow, importance of fee, importance of CASA, importance of liquidity. Earlier, we give a term loan. Happily, we are waiting. Client come every month and pay the amount, but nothing you are getting in terms of cash flows. No income, no float income. Only the NII. Even to date, interest rates has come down. Our cost has gone up. Margins are very thin. So you can't survive only the long-term financing. So more focus on working capital, cash flow-based lending. One. Then fee income is another very important tool you have. You need to focus more fee income. Why? Remember we were talking about no cash out going, no cash out from your balance sheet. You just offer service, contingent liability, or balance sheet financing, you name it. But so many products. It could be remittances, it could be CASA management, it could be internet banking, it could be insurance, trade financing. Because you can earn a higher profitability because it's all is income, all as other income. You think about making bigger profits. How? NII is now thin, very low. You need to focus more on fee income. Okay, so then that's a number two. Asset-based lending also, like pawning, gold loans, hire purchase, there may be some tax benefits to an extent. Risk levels also now come down. Good concentration. But rather than doing all working capital, rather than doing all long term, you move to the asset-based funding also. That's why many banks now opt to do their own leasing than subsidiary. Pawning also come as handy. In time to come also, we see quite a number of pawning business also happening through banks. Not having a very big portfolio, but because you can get bigger margins there. Anyway, you have asset, no? Very, in almost all scenarios, pawning gold prices has gone up. Very rare on 1 or 2 occasions it's come down. But if you're proactively managing that type of a portfolio, you get a bigger income while a lesser risk. Why? There's asset, underlying asset. Cashback, if you can promote cashback loans, again, deposit, you are meeting your liabilities while you are minimizing risk and offering advances also. The book goes up. Lower margin, but lower risk also, because there's asset. Cash management, CASA, internet banking, or some other financial services, value-added services. Their main focus is to have access to low-cost funding and further fees. Right? Some banks, their CASA, current account, portfolio, current account basis, a very big, means what is their cost of funds? Only in current account is 0, right? So, what a good position you are in then. Others, yes, they have to have savings accounts, fixed deposits, which are higher cost compared to 0 cost. So, if we can manage your lending through current account, what the heaven you are in. I know for sure there are some banks, their current account balances are so much. All are 0 cost. Then effective cost of funds is come down and a better wicket, better position to win customers, better position to fight with your competitors, because their cost of funds may be 5, your cost of funds is 3. So there's a 2% play now. So you can even at 5%. The others can't even think. Okay. Then another point is when you offer internet banking, technology-based services, it's good for you, right? Transaction cost, people cost, admin cost, premises cost could come down now. Over the counter, now it's over the internet. So everything could be done in that way. So it's easy for customer, easy for you. You get an income for the services you offered, right? So those are the new trends, even right now being deployed, practice, but keep eye on that. Always thinking that way. Why not we move to this? Why not we go to automation? Right now, so many activities in a bank are now done from home, right? Work from home. Right? So it's a new direction, a dimension. You have done it for about 1 to 1.5 years. Now it has gone into a DNA now. Banks also now cutting down expenses and see whether it could be practiced in future also. Maybe in terms of cost, yes, it could be good, but in terms of other, yes, there may be some cost or maybe some complaints, all that, but you need to think in that way. So new developments in terms of products, offerings, service levels, cost initiatives. So you need to know all those things. So sometimes that examiner would ask about what are the new trends in banking. How do you manage the new atmosphere in terms of post-pandemic? What are your thoughts in managing customers in a pandemic situation? Are some of the questions that he would pose to us. So think in that way. What's the best answer that I could give? Don't wait for the last moment and to have your answer. So right now think, what is the present situation? What our bank is going to do? Our banks is doing now. What other banks is going to do? How they are, cope up with the situation. How we are managing our staff. How we are managing our processes. just think and put down and have some answer. So then in case if the examiner asks, it's a different question, but you have some ammunition to answer that question. Okay, right. Any questions? Fine. So basically, you consider leasing and asset base and in personal financing in the branch currently. And we look into the DACR too. So is it fair to categorize leasing and asset-based lending? Yes, Amindri. Very good question. Because generally, a leasing could be a hybrid. It could be asset-based. It could be cash flow-based also. But majority of the features are it's related to security-based or asset-based. Why? Finally, 70 to 80% of your decision is based on what type of asset you are financing, which country of origin, right? What's the value of that particular asset? And so based on that, that's what LTV and everything has come up. But still, yes, we need to know how he's going to repay. So that's why we bring the cash flow based lending into this. That's why we are comparing the DSCR for the particular individual, particular business, how they are going to repay. So predominantly we say it's asset based, but as I finally told, it's a combination of two activities. It's a cash flow based, asset based. But generally, there is no hard and fast rule to say that this asset based, this cash based, so this is security based, this is fee based. So you can't categorize all your products offerings into these pillars, into these methodologies. But for learning, understanding, we have done this. But practice, as I told you, there may be a couple of categories together we offer. Hope I answered your questions, Amindri. Any further ambiguities on that? Or am I explained it clearly as to your expectations? Very good. Right. So, okay, Samindri. So, what basically I wanted to discuss today is all about type of categories or the categories of lending. 4 things we have learned about their introduction, advantages, disadvantages of that. So there may be possible examination questions on that. Then secondly, we discuss about what is SME banking, SME lending, definitions, why it is important, sectors, right? And then finally about new trends of the SME or the general banking. So having said that, I'm planning to wind up today's session, and there's an rest of the presentation is all to you. We will attempt some past paper questions to address some of these products, but so you need to go through the product, each product, and thorough at least to 10 to 12 product by heart. Because when you see the past papers, the examiner has asked some specific question about write a short note in product, about term loan, about OD, about import loan, about leasing, hire purchase. So we need to be ready for that. So you can go through and get an idea and be thorough with the products. And later when we switch to the past paper questions, I will discuss at least 10, 12 products, which is in the past paper. So it could be a further value addition to you. So any questions from you on what we have done last week and this week? Right. If not, thank you very much for joining today. So we will meet maybe next week. So the next week, so we will again continue with SME banking, where our discussion could be sources of financing and the institutions on that. Samindri, you asking hire purchase, right? So again, I will briefly explain hire purchase. We have in detail there. Hire purchase something, let's say, so you want to purchase a second-hand vehicle, or you want to purchase a fridge, you want to purchase a TV. So then there's a hire purchase act where a hire purchase company can advance you to purchase a particular machine or particular second-hand vehicle, where you are paying monthly installment to the particular the entity like leasing, but you bring down the asset for your consumption. After a particular period, the ownership is coming to you. But then there are some differences between the leasing and hire purchase, where in leasing that there may be VAT component involved, where hire purchase you don't have any VAT component. Especially a leasing that you do unregistered vehicles, hire purchase you do registered vehicles and the other commodities. And in hire purchase, there's another special provision where if you have paid 75% of more on the hire purchase transaction, then the hire purchase company cannot annul the agreement. But leasing, you can do that. So there are several, pluses, minus in the hire purchase and the leasing. So I have given them in detail in the product also. Some of you can read through. But when come to the past paper questions also, that we will discuss the kind of leasing and hire purchase, because there is a question to that effect. Hope that you can get a brief idea, understanding about what is hire purchase. Right. Is it clear, Samindri? Because I just give a briefing, because I have not discussed in detail, because it is in the reading material. Right. Again, thank you very much for joining. So let's meet next week at usual time, 8 o'clock. So we'll discuss sources of financing and the institutions and the other concessions available for SME customers. Right. Thank you very much, team. Okay. Take care.